Welcome back to Real Talk with Marcus. In today's video we will look into the Federal Reserve. The Federal Reserve's decision to pause rate hikes is a welcome break for savers and borrowers who have been facing rising interest rates in recent months. However, lower rates are not on the Fed's radar anytime soon. How a rate hike pause affects checking and savings accounts. Checking accounts that pay interest offer the most meager returns, but you need quick access to the money. Interest-earning checking accounts paid a national average of 0.04% monthly in September 2022. A year later, that rate had risen to 0.07%. Savings accounts offer a better return than checking accounts, but you may have to keep a minimum balance to avoid fees. Last year, in September, the monthly average interest rate on a traditional savings account at a brick-and-mortar bank was 0.17%. In September 2023 it's 0.45%. High-yield savings accounts pay more. Yahoo Finance is seeing high-yield savings account APYs of 5% or more. Money market accounts often boost your return from a common checking account, but you'll likely need to deposit anywhere from $10,000 to $100,000 to earn the raise. Last September's national average monthly interest rate was 0.18%. 1 year later, it's 0.65%. What Fed policy does for CDs? CDs are another option for savers. As the Fed has been pushing rates up, certificates of deposit earn more. A 12-month CD was earning 0.60% monthly interest in September 2022. A bucket of rate hikes later, the same term CD was paying 1.76%. The best CDs are already topping 5% APY. Consider a CD ladder to surf the rising wave of interest rates. What the latest Federal Reserve move will mean for loans and mortgages. Higher interest rates mean you pay lenders more to borrow. Personal loans. Interest rates on personal loans have risen from 9.39% at the beginning of the Fed rate hikes in March of 2022 to 11.48% in May 2023. That higher trend is expected to continue until monetary policy officials believe the fight against inflation is won. Student loans. Most federal loans have fixed interest rates, so Fed policy doesn't impact them. Private student loans may have a variable rate, and Fed rate hikes can be a factor. Home mortgage loans. Home loan rates have soared. When the Fed hikes began, lenders were pricing 30-year fixed-rate mortgages around 4%, according to Freddie Mac. After peaking at 7% last October, home loan interest rates eased slightly but have bubbled back up. The Fed doesn't directly influence current mortgage rates, they're a function of lenders tracking financial markets. However, if high inflation continues to ease, it's likely that home loan rates will soon follow. It won't be a diamond run descent. It took nearly 20 years for mortgage loan rates to fall from 7% in 2001 to an annual percentage rate under 3% in 2020. And homebuyers may not see lenders price home loan rates that low again anytime soon. The 50-year average for a 30-year fixed-rate mortgage is well over 7%. How a Fed interest rate hike impacts credit cards. Credit card interest rates have moved from an average of 16.65% to well over 22% during the Federal Reserve's latest rate-raising cycle. No doubt, those variable APR interest rate charges on credit cards will remain high as long as the monetary policy holds firm. That means minimum payments due won't ease and stiff interest charges on credit card balances will remain unless you pay off your cards each billing cycle. This is our conclusion. The Fed's decision to pause rate hikes is a welcome break for savers and borrowers, but lower rates are not on the Fed's radar anytime soon. Carefully consider taking on any additional debt as interest rates remain elevated. If you do initiate a new loan, budget your monthly payment for rates to remain mostly stable. Thank you for watching, and never forget, more gains, more gains, more gains. Giving it your maximum effort.